Happy Valentine's Day, folks. This is Steve Memory from Iconic Wealth Management with an educational economic update for February 2018. In this month's video, I'll discuss some of the major headlines that influence markets in January. I will also provide insight into what those developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. January 2018 is behind us, and stocks posted quite a positive start to the year. In fact, even anticipation of the first federal government shutdown since 2013 didn't derail markets. The S&P 500 and Dow both had their best monthly performance since March of 2016, with each rising over 5%. The Nasdaq gained 7.3%, making January its best month since October of 2015. Several details that came out during the month indicated that a strengthening economy is driving market performance. Initial readings of the gross domestic product, GDP, showed the economy grew by 2.6% in the fourth quarter. Though smaller than projected, the increase still implies healthy economic growth. Corporate earnings data also suggests that the economy continues to expand. During January, many companies released their earnings report for the fourth quarter of 2017. By the end of the month, 81% of the S&P 500 companies that had shared their earnings data beat expectations, and 83% exceeded revenues. In addition to growing corporate earnings, labor measures seems to illustrate that the economy is advancing. The ADP employment report indicates that private companies added more jobs in January than analysts expected. Further, fewer people filed for unemployment in late January, keeping initial claims close to a 45-year low. Unemployment currently sits at 4.1%, could go as low as 3.5% by the end of the year. Wages are finally starting to pick up as well. According to the Labor Department, the Employment Cost Index, ECI, in the fourth quarter was 2.6% higher than a year before. This increase is the largest since early 2015. Examined together, you can see a growing market, increased corporate profits, low unemployment, and rising wages. This positive news is not without risks. If the tight labor market leads to faster wage growth, inflation could increase. At that point, the Federal Reserve could start raising interest rates more quickly than anticipated. This has resulted in some fairly significant market volatility to start off February. The Fed meeting at the end of January, and they decided to keep interest rates the same for now. They did indicate, however, that they expected inflation to increase over the next year. With U.S. consumer prices rising 0.5% in January, that's an increase of 2.1% year over year, it appears inflation is the big story at the start of 2018. After years of inflation missing the Fed's 2% benchmark, the markets must now decide how to react to prices increasing more rapidly. Ultimately, we have strong growth in corporate earnings on the one side, and potential for faster than anticipated interest rate increases on the other. Expect more volatility in the near term. Now, looking ahead, we will continue to analyze the interplay between economic growth and inflation. Only time and data will tell exactly how these connected pieces will come together. But we will work to keep you informed along the way. That's it for this month's Educational Economic Update. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the month of February 2018. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 703-891-9518. We're always happy to talk.